This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Down the stretch we come, headed to the end of another strong year with the indexes near all-time highs and the Dow knocking on 50,000. On this week's show, we look at how we got here over the past 25 years. And of course, we look ahead to expectations for both 2026 and 2027. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein. Here we are, the home stretch now, and by the time you're hearing this, many of you have enjoyed the Christmas holiday and are looking to the new year. And I alluded to making this week's show a bit about not just this year, but how we've gotten here, as I thought maybe when I recorded the last show that we would have already reached Dow 50,000, and maybe we will by the time you hear this, but today we're about 3% away, and it's close enough, and I'll circle back to some history with that later. But first, a bit about this year, and of course, what we might expect for what comes next. On Tuesday, we got a really strong initial GDP number, which, although it's kind of the purest reading of the economy, it's really not a number that gets a lot of emphasis for economic forecasts because it's going to be revised quite a few times, and it doesn't tell us much about what's coming. The street would rather focus on leading economic indicators and then actual earnings from companies, not to mention the guidance that those companies give. But we've got an initial print for the third quarter of a 4.3% growth rate versus the consensus estimate, which was 3%, and the previous quarter, which was growth of 3.8%. And in reaction, the Wall Street Journal that day featured a lead article that said that the economy was unexpectedly robust, powered by strong consumer spending, which is evident in the data, but is also a striking juxtaposition from the worsening unemployment data and a consumer confidence report that was worse than expectations this week. So I guess they're just spending, but not necessarily happy about it. Maybe they're just spending more money on fewer actual goods. Indeed, the journal went on to say that it was the highest recorded growth rate in 2 years, but what stood out was both spending on healthcare and also on recreational vehicles. So kind of a weird mix there. An analyst over at Goldman focused more on the labor side, saying, quote, "The job market outlook is less inspiring, in part because the ongoing productivity acceleration raises the bar for how much GDP growth is needed to create jobs. The disconnect is particularly pronounced in the U.S., where the unemployment rate is trending higher despite solid GDP growth," end quote. And when making their forecast for next year, Goldman Sachs went on to say, quote, "The key risks are that a fragile job market sparks recession fear, or the equity markets questions the value of AI-related revenues," end quote. And I'll circle back to that in a minute. I think a lot of the focus really projects out further, likely into 2027. For now, the struggles in the job market are likely to facilitate additional rate cuts. And while the economy continues to grow and supports both earnings growth and good returns on equities, it also then could lead to further deterioration that finally strikes later on, I think, in 2027, maybe with a recession, which is more likely going to be at least that far out in the calendar than in the immediate future. And if that's the case, then tread carefully with consumer discretionary companies, which are actually amongst sectors that are expected to have the most growth in earnings in 2026. According to FactSet, every of the 11 sectors are predicted to report year-over-year earnings growth in 2026, with 5 of them expected to report double-digit earnings growth, led by IT and communication services, which are basically a combination of tech companies, but also the consumer discretionary sector. And paying premiums for them in the latter part of next year, especially that consumer part, well, that could be potentially problematic if that worm eventually turns. Now, this rate of earnings growth is not expected to be matched, and rarely is, equal amounts by the revenue growth, where again, according to next year's summary of estimates, The tech areas are expected to do quite well, but the energy sector stands out as the only sector not expected to grow revenues for the entire year. And it's been kind of a lagging sector for a while now. But, while the normalization of Russia energy supplies, that seems to be far from any time soon that they'll be able to get really back on the market. And of course, there's been a recent increase in the global crackdown on the Russian shadow fleets. They've been seizing some ships in the North Sea and what have you. But we're also, of course, seeing a pickup in prices a bit lately as we start to disrupt Venezuela's oil exports and further efforts that we may soon see to take them off of the global market could then support higher prices and potentially higher revenues for the big U.S. energy companies. But those guys are going to also need some help from higher prices and continued higher prices from natural gas revenues, which we could see if we do indeed have a colder than average winter here in the U.S. More from the macro front, Goldman Sachs in their 2026 macro outlook focused on the return of deflation, where inflation has already been trending lower globally, but they expect it also now to be reflected more so here in the U.S. economy next year, as they say that the effects of tariffs may no longer be showing up in the year-over-year data. Yeah, they might still be applied, but when you measure it versus the early months of 2025, it'll start to fall off the year-over-year inflation comparisons, because Goldman says that they estimate that the U.S. inflation actually this year in 2025, the real inflation rate they say is actually about 2.3% which is not something you really can do, but if you were to strip out the effects of tariffs versus what the real recorded rate, or at least the PC inflation rate, ran at about 2.8% this year. Now, the risk to this thesis would be the threat of any additional tariffs, of course, being applied, while the existing tariffs may also start to show up, even though they've been applied throughout much of this year, they may show up more so in the beginning of next year for the consumers, if not actually reflected in the data. But if the businesses start to actually more willingly pass along these tariff costs to the store shelves, more so than they've been willing to do this year, where they've been absorbing a lot of that cost, that's a potential inflection point that can lead to some volatility in this coming first quarter. And while I've recently argued that we could see a dovish surprise with a January rate cut, which is not what the market expects, and it seems like a long shot, I think that potential is still kind of there. The street's not banking on it, though. It's not in the numbers. But it might be supported by last week's inflation data. Now, if instead the inflation numbers that Goldman's talking about here perk up a bit in the first quarter, the markets may actually have a bad reaction, albeit perhaps to a limited occurrence of that upswing in inflation that ultimately then could create pretty good opportunities if you were to take advantage of that volatility for returns later on in the year as that inflation data starts to cool back down. However, it should also be noted and taken seriously that while spending on AI, I think, will surely continue through next year, as the dollars that are committed are really unlikely to suddenly grind to a halt, the market, though, may see waves of volatility, just as we've seen some samples of in recent months, as we get the actual results from the companies that are applying AI. And if they show any near disappointments, as Goldman again identifies this as a key risk for the macro economy next year, as they call out the threat of the markets questioning the actual value of AI revenues. So far, the valuations from that space continue to make new highs, but earnings season is going to fall under a very hot spotlight in this coming first quarter. The bottom line to start the year is that tech spending is going to continue to flood the space, and we will see broader participation in some other sectors as more non-tech companies start to increase their own spending when they start gaining some more confidence that they lacked a bit this year. And then they're also expected to receive further stimulus from the government as some of these tax bills really start to take hold in the coming year. All right, I'm going to hop on to a quick break here, but I'll be back in a moment with more on what to expect, and then we'll take a look back on the Dow's trek upwards to 50,000. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
The unwieldy fire hose of daily news flow is only getting stronger. How do investors separate the noise from what actually matters? Tune in every week as we discuss the latest financial trends and how to filter what's distracting you from investing success. Listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group. Or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. Where we stand today is that the S&P 500 currently stands at about 22 times the consensus estimates on FactSet to next year's earnings, which is far from an unprecedented level, but well above the 5-year average of 20 times forward earnings and the 10-year average, which is about 19 times forward earnings. However, earnings growth, as I laid out, is currently expected to grow faster next year than it has been recently, as these same analysts are now modeling for 12.5% growth next year, versus what we look to be pointing towards. This year's results are finally not in, of course, but looks like we're going to have 9.4% earnings for this year. And today, the Dow Jones Industrial Average is about 3% away from 50,000, a number that when it's beat, it's probably going to make a few headlines. And today, the S&P 500 is just about at its all-time high, and it's also knocking on 7,000 for the index, with Goldman Sachs and JP Morgan both putting price targets at about 8,000 for the S&P for next year. Now, the Dow Jones first hit 10,000 in March of 1999. And later that year, James Glassman got a bit of attention, released a big book called Dow 36,000, which was a number that he projected that Dow was going to reach within the next 5 years at that point. He said, driven by an undervaluation in the markets, even though the markets were not cheap. The markets were actually trading at over 30 times earnings at that point, which were 30 times some pretty optimistic forward earnings estimates for the next year. Of course, that didn't come true. So trading at a tremendous valuation. And also, he said that the driving force of the demographics of the country at that point and the cash flowing into investments from this maturing population and its ability to save would continue to drive the Dow from 10,000 within a few years to 36,000. Unfortunately, the Dow didn't reach 36,000 until 2021, which was kind of the start of the driving bull market we've basically been enjoying recently after that initial onslaught of the COVID pandemic. And for the 10 years following that year, 1999, when it first hit 10,000, the Dow offered an average annual return, even when including dividends, that was slightly negative per year, after reaching a low print of about 6,500 in March of 2009, 10 years later. Now, I'm switching back and forth here between the S&P 500 and the Dow Jones, and they're not fully interchangeable. And recently, we think of the S&P as more of this kind of growth engine, as it's become so heavily weighted in a pretty concentrated handful of big tech companies that have been doing very well. But for more perspective on that, or maybe for perspective on expectations overall, some food for thought here. From about the lows of the financial crisis, which bottomed in March of 2009, so a very low starting point there, up until October of this year, so we're going to take it from the low point of the financial crisis and bank a lot of pretty good years in there. Along with dividends, the S&P 500 has averaged close to 10% per year. And 10% is a very solid number for an average return. might not feel like that over these past few years, but that is measuring from a very low point in time till today, and we got that nice average 10% return. Keep this all in mind because while I'm sharing various outlooks for the coming year and data that seems to suggest that we'll have continued gains in the markets, beware of the hype that we might see from the Dow hitting 50,000 or the S&P hitting 7,000 or even 8,000. And unfortunately, to keep it very short this week, because I too have a holiday coming up here, I'll sum it up by quoting my partner Greg Smith, who likes to base his financial plan models with projections on basically the worst 20-year period in history for a balanced portfolio and what that average return was. While you may have time on your side, if you have a long time horizon, even if some of you here are listening in your 70s or 80s or even more, some of the dollars you may be investing may project beyond your lifetime. But for dollars which you may need to call upon in the coming year, money you might need in the next year, 2, or even 3 years, you need to keep it pretty safe, earning interest and secure. At Dow 50,000, we're pretty high up on a ladder right now. And although it will likely be substantially higher if you give it enough time, they used to say Dow 10,000, some people said it was a ceiling. There were a lot of people during the next 10 years that thought the younger generation, even younger than mine at the time, was going to be lost permanently as investing. I remember anecdotes that say this is a generation that will, for their lives, lose faith in equity investments and look elsewhere for their savings because it was such a long period of malaise in the markets. There were good years in there, there were ups and downs, but overall it's not like it's been lately. But right now, as we're up on that high step of the ladder, don't reach out when you're on the highest rung of the ladder and painting. You don't want to stretch very far out there and extend yourself with this metaphorical risk right now. But instead, keep the money that you need safe and close. But for the money that has enough time to enjoy growth that real companies actually provide over time, through growth of earnings, through expansion of the business, then you can afford to invest in what seems like it could be one of the peaks in the market. I'm not saying this feels like a peak, but I always hear that when markets are doing well, there's that subset of people who say, well, it feels very peaky here because it's been doing well. Well, if you have time, then you can afford to invest in it at what might seem like a peak, and that peak will probably come a lot later than you think, and it's not binary. The markets don't just make peaks and then go all the way, retrace it all the way back. Given enough time, the markets continue to make new highs. But if you have that time on your side, you can weather the storm that may come along. As you ultimately will be better for it if you give it enough time to deliver that true value that comes from true corporate fundamentals. Even back in 1999, if you weren't buying the stocks that were defying gravity, the big dot-coms at the time, the ones that didn't seem to really have a lot of logic behind them, but instead you were focusing on the fundamentals of the businesses themselves, then you would have suffered less on the downside and saw returns likely that exceeded what I've described here today in these indices. That was a 10-year period of time that was dead for the indexes, but equity investors actually could have done quite well if they stuck to fundamental investing, if they focused on achievable growth, if they focused on dividends and strong balance sheets. The stage is set for the markets to trend higher, and most of the analysts are banking on those data points and the guidance projections in their estimates. So let's not be rash and assume that they're all wrong here, but whether you're one who's too bullish or too bearish, it's best to stay actually within those guardrails. Be within the guardrails of a prudent allocation of risk and also apply some logic to what you own rather than try to figure out what the heck you were thinking after a bit of a correction rolls through and wonder why you own some of these names. That's my lasting thought to close out the year here. Another one where the markets navigated endless challenges in a world seemingly full of turmoil. And I hope that you have a wonderful holiday season and a very happy new year. For the Wise Investor Show, I'm Chase Hinderstein.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.